Welcome back to another week of the Educated Homebuyer Live. My goodness, has it been a week since we've been on here last? I mean, last Wednesday we were on here. Things were looking positive. We thought, hey, we were trending lower, and then Friday, wow, we saw the bottom fall out. We thought, wow, this is where it gets really, really good. And then it got really interesting. And today just added to it. So a lot of volatility out there in the market.
The funny part is last Wednesday, I showed that 5-minute chart just so everyone could see the volatility while Trump was talking. And it looks like a tiny little blip of everything that came after it. That was just the preview of the coming attraction.
The craziness of the last week. Today, probably the craziest from last night, closing of last night until today. Probably the most volatile market, Josh, I can remember since probably the financial crisis back 07, March, April of 07, when things were just bananas.
We had crazy stuff during COVID. The COVID stuff, when it first jumped off, you had some things where there was a lack of liquidity and bonds shot to the moon, and then emergency Fed meetings on weekends with 200 basis point cuts or whatever the absurd number was. But yeah, you forget about it when it ends up good and in your favor. You remember about it when it was awful and forgettable.
Yeah. So with that, we're going to talk about it tonight in some detail. We're going to look at charts as we always do, update you on the economy. If you've been hiding under a rock, we're going to talk about tariffs a little bit and how that impact has shown all the way through into mortgage rates, which in turn is going to filter through to demand and everything else that we talk about here on the show. But while we're doing that, let us know where you're watching from. Let us know what questions you have so that when we roll out of the charts, we can get directly into it. We got Dixieland saying that our thumbs up button isn't working. So I don't know. We can't correct that.
He's saying our viewers here are not hammering it like they're supposed to.
I got it. You know, it takes me a little while, Josh, especially after like a day like today. My brain just doesn't work like it.
Just do what I did. Walk across the street, get a pack of Marlboro Reds, blow the whole thing back, and then you feel good as new.
Just smoke the whole pack at once.
The whole pack at once.
The whole thing. So that'll calm the nerves down, right? All right. So let's do that. Let's take a look at charts. Start there as we always do and see what's happening. And then we'll talk about rates and all that good stuff. So inventories continuing to go up this week. We saw a sizable jump, sitting 691,000 single family homes on the market. We're up 35% more than this time last year. Josh, what does that say? That says we went from 675 last week up to 691. So roughly 16,000, just under 16,000 homes added to the market, which is, if we could keep that pace week over week, that would be a nice bump to inventory. Again, our peak last year was at 739. We're not there yet, but I would think, again, by mid-May, we're probably going to surpass those numbers if we continue at the pace we are right now. Orange County, 3,822 active listings on the market. Single families, townhomes, condos, everything. That's up 3.48% week over week. Huntington Beach up 1.53% week over week, sitting at 261. So still not above the peak of this year for Huntington, pretty close, but Orange County inventory continuing to grow. And that takes us into looking at calculated risk and their active inventory. And again, these are select markets that he looks at. But in this example, you kind of look at, what's increased year over year and then take it back to 2019. So all the markets are up year over year. But then when you compare it to 2019, you still got Las Vegas is down, Raleigh's down, San Diego's down, the Northwest as a whole is down, but then you've got markets like Denver and Nashville and some of these markets showing increases back to 2019 levels.
That Denver stuff is crazy. You would think up 55% from a sort of a balanced market from 2019 that it would be weak out there. I've got a couple buyers, one in Greeley, which I know isn't right next to Denver, and another one in the Denver metro. And it's not like they're just finding tons of homes that they can go in and lowball offers on.
Right. You got to also remember, I mean, it comes in, it's price points, right? We don't know what price points some of those homes are in. But this shows the 1 year change in active housing inventory between March of last year to March of this year. You can see what market you're in. Not going to go over all of these. We're in California. It's up 50% versus last year. But I think this is the important chart. Now we're looking at March of 25 versus March of 2019. So we're still down 20% here in California. Whereas, Texas, Florida, some of these, Arizona, what Colorado, some of these areas definitely positive, not by a lot, but definitely up. Texas and Florida obviously being the most there, but Northeast still down considerably, big time. Illinois down 65%. I mean, geez, that's a big drop from 2019.
That tells you everyone's moving out of there. No one wants to live there.
Yeah, it could be. You never know.
It's cold.
Active housing inventory for sale. Did I put this in here, Josh? Or
I threw it in there for you, Jeb. I thought it was a nice little bonus rather than just on the state level. Look in your metros, and it sort of breaks it down. The size of the bubble tells you, and then also it just breaks it down more metros versus just the state level. So it's still a nationwide chart. But this one, the last one tells the same story, but that whole Northeast is kind of boggling. The Northeast quadrant there, that they're still so supply constrained.
No, and dealing with it big time. A lot of multiple offers, a lot of homes, just still selling above the asking price, all that good stuff. So new listings new listings came in at 72,000, which you can see is a decent jump from where we were this last year. In fact, inventory this time last year was actually still declining. We hadn't seen really the change in inventory at this point. So new listings were somewhat stagnant. And so this year, obviously a big difference. And this takes us into new listings. Again, same style of chart, but from calculated risk. Again, take a look at year over year and then compare it to 2019. When you compare it to 2019, most markets are still down when compared to new listings coming on the market for this season, if you will. Home prices, median price at $397,500. That's 0.25% greater than a year ago. So basically flat. 8 states now have price declines versus 2014. Texas, Florida, Georgia, South Carolina, Arizona, Iowa, San Diego, and Washington. And it looks to be next in line. They're thinking Colorado and Tennessee. And we're going to take a look at a chart here in a moment that's going to show that in a little bit more detail. But home sales, 72,000 new contracts pending. Plus 15,000 condos coming in there, and then price cut sitting at 35.1%. This is a chart showing you all the markets where home prices have declined. They say falling, I say declined. Some of them are larger than others. Some of them are basically just under, not even a full percent. So that's why I say down. But the chart on the right kind of just shows you the concentration of where the majority of these are. And we've talked about it. Florida, Texas, these markets seeing a lot more markets declining overall than other parts of the country. But you guys can take a look at that in more detail. Average mortgage loan to value, Josh. So this is important because we talk about 40% of homeowners out there owning their homes free and clear, owning their homes free and clear. And of the 60% that's remaining that actually have a mortgage on their home, about 70% of those people have an interest rate below 5%. And on top of that, a lot of equity.
This is a new data provider, Batch Service. I'd never heard of them before, but Lance over at Resi Club had them. FHFA runs the same data, and they're showing nationwide those with mortgages are at about a 60% loan to value, but this breaks it down by geography here. So you can see your mileage is going to vary depending on where you're at. What we got is that South Dakota, they're at 44.8 average LTV, and what the highest you have is probably New Mexico there at about 76. So when you compare that to 2008, it's just a night and day difference. The nationwide number was like 92%. So it just depends on your measure. I thought it was a good look. I like the way it broke it down here. What you were hinting at, Jeb, the number of loans at different interest rates. This just shows you sort of the chart. I think this is actually a little bit better and easier to follow. We got 72% under 72.1% under 5%. So not only are they little loans, they're little loans at relatively very low relative to current interest rates. And the majority of those somewhere between 3 and 4% or under 4% when you say, we got 53% of them. So most people, tiny loans, very low interest rates, not a lot of pressure. Look at me leaving a slide out here, Jeb. I wonder what that was. It was probably a fascinating slide, or the most interesting one of the bunch. We got CPI coming up tomorrow. Normally, that's a big deal. No one's talking about it because of all of the tariff chaos. These are the projections from the Cleveland Fed. So tomorrow looks pretty good. 0.26 month over month for the core, 0.03 on the headline number. And then next month, not looking as good. 0.3 is what they're projecting, and then 0.25 on the core. But when we throw it in here, This is the headline number. We have a 0.3 falling off there, Jeb. So on the headline, you're probably going to see a nice number. Next month is 0.3 with them projecting a 0.3, so not much progress. And then for the following 3 months, almost impossible to see any progress coming on inflation. So from that end, we are unlikely to see a lot of improvement. We're looking at the numbers. If we look here at this chart, Jeb, it does show the numbers. 2.5 on the headline and just a hair under 3. So everything, and when you throw in the PCE, both slightly lower, everything is back to having a 2 handle on it, but not nearly as close to 2 as anyone would like. So it will be interesting to see, in light of all of the chaos over the last 7 days, how the market trades this tomorrow. We did finally see some of that expected bounce in the Atlanta Fed GDP now number, but that was after a big dip last week. We got almost to -4 in their projection. You continue to see the consensus from the blue chip economists. They're down under 2%, well under 2%. So we are trending towards what would be considered recessionary if you had it for a couple of consecutive quarters. So Jeb, here's now we get to the fun part. We're going to talk about tariffs and just all of these things. This is a little chart here. This shows you that on average, since Inauguration Day, every 3 days, Trump has had an announcement escalating the tariffs, culminating in this week. I thought that was somewhat interesting. On the flip side, we look here, this is not just a US thing. This is global protectionism rising since the great financial crisis. So you see from 2008 through to 2024. In the US, we are the top little gold box up there. So we're not even, 15% or so of this protectionism. And most of it's coming from other G20 countries outside of China, EU, Mexico, Canada, and the US. So this is certainly we have the headlines, and we're doing it the loudest and most Americanist right now, but it's not just a US thing. This chart, Jeb, shows who we trade with worldwide. So the number was astronomical of the amount of countries impacted by the big tariffs that were announced and then postponed here. But if you look, we do most of our trade with China, Canada, Mexico, and then the EU. Japan, UK is no longer the EU, but you got Germany, Netherlands, Italy, Australia, Belgium. So we're dealing with, if we go 80-20 on this, I would bet you what we got between the EU, Canada, China, Mexico, that's probably 80% of it right there. So I'm not sure why we're escalating this worldwide when we have a handful of trade partners that we could take care of this with. This puts this into perspective. There can be a situation where no one wins, but in terms of leverage, we are less trade dependent than the rest of the G20 by a large margin. So someone explained it this way, that if those tariffs stay in place the way they are, it's a one-way ticket to recession for us. But for almost all of these other countries, it is a one-way ticket to depression. So we are motivated to negotiate some way out of it. They are highly motivated to negotiate some way out of it. A lot of what we hear, Jeb, is that the reason for the tariffs is we're going to bring back manufacturing to the U.S. This is manufacturing, construction spending, and other than computer electronic electrical, which is basically post-CHIPS Act there in 2022, that's really the only thing that is growing. When we look at this, some of these tariffs don't make sense. We're not going to reshore construction or manufacturing of how it shakes out. More importantly, Jeb, when we put this in the context of construction, this shows you here that only about 7% of all goods used in the new residential construction is imported and would be subject to tariffs. So I think the number from the National Association of Home Builders was 9,800, Jeb. They say the average new home will increase by about $9,800, or at least their cost, if they were able to pass it all on, which if you're in an area that is a heavy dose of supply and not as much demand, they're not going to be able to pass that through. So Jeb, you talked about the chaos. I made a chart so that our friends could see the chaos. So on the left side of that, we say the last Wednesday was when those tariffs were announced. We saw a dip into the close and then kind of sideways, but down into Friday, and then a big dip down at the open. So before we even got a rate sheet, we were down under 390 on the 10-year. By the time we closed, we were up over 4%. Monday, we come back in again at the open, back down under 390. And then the rest of the week, just a moonshot up to when we come in this morning, we're at 4.5. So a 60 basis point increase in the 10-year treasury in like 48 hours. That is very, very uncommon. And then since then, we see this today, just they got better, got worse, got better, got worse. We ended up here. And if we look at the chart, we are back right at the very top of that sideways range that we've been in for the better part of 3 to 4 weeks. So tomorrow will be important for us to see what the next move is. If we fall back within that sideways range, or better yet, get back down under the 200-day moving average and that falling trend, would be good. But I don't know what your thoughts are, Jeb. You and I have been talking about this. What is resolved? The reason why we got back down to that yellow line was at what, 10 a.m., 10:20. I meant to throw that in as a slide, just what the 5 back-to-back announcements that we're kicking the can down the road 90 days. So I don't know. I don't know what resolution or what improvement we get over the next 90 days. It'll be interesting, as always. One thing, Jeb, we haven't looked at spreads here recently. So spreads are in a down channel still, but whenever we get an increase in volatility, the volatility we just looked at in those last 2 charts, spreads are going to blow out. And you see that they're the highest they've been in what, probably going back a couple of months, but we're still within that down channel. And as long as rates continue to trend down, and if we work our way through this, get some of the volatility down, we should continue to see them normalize, which will be a tailwind for lower interest rates. Where does that leave us? Mortgage News Daily reporting 695 today. That's about right. Had a borrower with a low 700 credit score that was a hair above that today. Had another one with an 800 credit score that was still going to be, 6.75-ish. But we'll see. This doesn't reflect where the market moved into the close. So whenever you have big intraday moves and there's volatility, lenders don't reprice all of it. So even though we saw improvement, they're waiting to see what happens at the open tomorrow. We may not see any improvement. It may get nicely better tomorrow.
Rate watch. I don't know. Did you see my camera just go out there, Josh?
Yes.
Anyhow, it's back in now. I'm back. Somehow it says I'm on a Wi-Fi. I've never seen the Wi-Fi. Connection is unstable. Not on Wi-Fi. So I don't know. It looks like I'm on Wi-Fi somehow, Josh. I'm not unplugged. Don't know what's going on here. Anyhow, if you'd like to get on the Rate Watch, do that. JebSmith.net/Rate Watch. And we'll keep you up to date, or Josh and the team will keep you up to date as rates move downward. I know there's some people on there hoping to get, what looked to be better rates, and then so much volatility in the market. I don't know that anyone was able to capture some of this stuff, but the best way to approach it is get on there. And then when we see some stability, they can actually reach out and guide you to the finish line. So with that, Josh, I think the biggest thing to take away from this conversation, guys, is that there's a lot of volatility in the market. This is not going to be a straight shot up, a straight shot down. You're going to have, looks like, big moves in either direction. I mean, the Dow moved almost 8% today. Never, right? That's got to be a record, 8% in a day. So, sitting on the sidelines is okay. You don't have to rush into this market. And I think it's important to say that. It's okay to sit on the sidelines and wait for things to calm down. But just understand that, a pause doesn't necessarily correct the quote unquote problem that we're dealing with at the moment. So expect more of this. It's not going to necessarily come tomorrow, but just if you're in the market, you're getting a house, lock your rate when you have an opportunity. When you know the number, you're comfortable with the number. You might not like it, lock it. Don't play the game, because otherwise you're going to be in a position where you could have some regrets. So
I don't think, Jeb, like right now, we're trend followers. We're trying to see, is there a trend? Is it sideways? Is it up? Let's definitely lock. If it's sideways, you can maybe wait and see. And if it's down, you want to let it give it some room to run. I don't know that we're going to have any level of certainty in any type of trend in the near term future. So if you are in the market, locking's probably prudent unless you're fairly comfortable gambling.
All right, good stuff. I got one of my my son's teammates. I'm his coach. Somehow he found me on YouTube. I got a follower of Kingston. Kingston reached out and said, "Hey, coach." So hey, Kingston. Anyhow, thank you guys for being here. Thanks for watching, King. Dixie is up in Minnesota. I know that. We got Jamie in Tucson. So thank you for being here.
I'm going to be visiting Tucson next month. Maybe I'll hang out with Jaime.
Tucson. That's what our soccer coach called it. And he's from Brazil, and he wanted to do a tournament in Tucson, and we were like, where the hell is Tucson? And then we realized what he was talking about. Anyhow, let's go up here. Start with this question, Josh. Would you buy a multifamily home that is on leased land? 38 years left in a current lease.
Let me start with a simple answer. I will buy anything if the numbers are right. So we have a variable here of a land lease that is absolutely going to change what is reasonable and what terms you would be willing to accept. Let's talk about the constraints that puts on us. To get financing, the lease has to run 5 or more years past the end of the financing. So at least with this 38 years, you could still get a 30-year loan on it. But let's flash forward, 5 years? Now you're down and you can only get a 28-year loan. In 10 years, you can only get a 23-year loan on it and have 5 years remaining. So the financing is going to get more difficult. The more difficult the financing is, the less valuable the property is. So most likely, even with 38 years left on it, it's selling at quite a discount. A leased land property will always sell at a discount to one that's fee simple, where you own the land, for the simple fact that you don't own the land. But the shorter the term of that lease, the more uncertainty you introduce. The harder the financing is, the bigger the discount you're going to need to get. So if I got a big enough discount that I could put a 30-year loan on it, and now remember, for the last 15, 20 years, people are like, well, I don't care. I'll just keep refinancing to a shorter term and a lower interest rate. Well, if you can't refinance when rates move lower in the future because you can't get the 30-year loan on it, you may not have that ability. So I'm expecting you're going to tell us there's a pretty big discount there, but I would push for a spectacularly big discount, because it's not going to appreciate because of that. And it's not going to appreciate like another.
I'm going to argue, Josh, here for a second. There are leased land properties that turn into fee simple at the end of the lease term. So you need to know what kind of lease it is and what happens at the end of that lease. There's community here in Huntington. About 10 years ago, they all converted to fee simple, and it didn't change the pricing in that community, just because they were basically single family homes and everybody knew. Some had already been bought out of the lease. Some were still on leased land, so on and so forth. On top of that, wow. Did you get all that?
That was fantastic. Wow. We won't edit that out of the replay.
No,
we'll let everyone experience that.
If the property is in a community of leased land properties, and you're using comps from that community to come up with the value of that home, then you're not necessarily looking for a discount on that property. You're looking at what the comps are selling for in order to justify the value of that home. There's several here in Huntington Beach that are on leased land. They're condo complexes. In those communities, they sell at a discount already relative to where that property would be if it wasn't on leased land. So I think that's probably what Josh is referring to, versus comparing it. You can't compare a leased land property to a fee simple property. They're just not the same thing. So I think that makes sense. But instead of going down a rabbit's hole and just talking about this nonstop, if you have additional questions, reach out. I know I'm very familiar with leased land. I've dealt with it a lot, and happy to kind of give you some insight. So that said, in fact, I've got videos on my channel that are old where I talk about leased land. So if you want to go back and look at those, they will maybe provide a little guidance for you. All right, Josh, I'm out of water, by the way, and my throat.
How do you start a live stream with no water?
I don't know. I thought I had water. I have no water.
There was a water in the fridge. I can answer a question while you go grab the water.
No, we're good. We're gonna wing it, Josh. Vince says, how low do you see interest rates going this year? Sorry if this has already been answered. So I don't think this is a question you can technically answer, but
he also follows up and lets us know he's looking to refi 7.29 rate on a 30-year loan, looking to go to a 15-year. Yeah, there's never been a time where it would be more difficult to answer until this tariff stuff is worked through and put to bed, which I would love to think happens sometime in the next 90 to 180 days. So we don't have to talk about wild cards and what happens. How low could rates go? Those spreads could get down as low as 2. The 10-year without the jobs market really rolling over is maybe a 3.7, 3.8, somewhere in that range. So high 5s is probably your best on a 30-year. So it puts you in the low 5s on a 15-year. If you're looking to do it, you could probably, depending on the size of the loan, you could probably justify doing a 15-year no cost right now, and then give yourself the flexibility to do it if and when everything clears up and rates do move lower, because you're going to have a pretty big spread there for the 15 to the 30.
All right, good stuff. Jamie is asking the question of looking for something larger. Current homeowner wants more bedrooms. Is it better to seek current home first, or need money for a new down payment, or to sell and buy a new home at the same time? So,
and remember, he's in Tucson.
He's in Tucson.
Which made the list of one of the areas for higher increases in what's the word, Jeb, when there's homes on the market? Inventory. That one.
Too good. Is it better? I think it depends on your financial position. Understand that typically if you are keeping your home and buying another home, right, you're going to need that money for the down payment. If you don't, if you don't have it sitting on the sidelines. If you have it sitting on the sidelines, don't need it from your property. But you also have to be comfortable making 2 mortgage payments, right? And know that what if that home doesn't sell immediately? What kind of position does that put you in? Are you going to be in a financial strain, if you will? Are you going to have to do things you wouldn't otherwise have done to sell that home when you've got another mortgage? That's what you got to consider. On the flip side, I think in most markets at the moment, contingent selling, like selling something contingent on buying something else, is pretty normal. It's become way more normal over the last couple of years than it's probably ever been. So I think maybe talk to a local professional in your market, find out what their thoughts are on putting your home on the market, trying to find something and close concurrently. It's realistic. It happens all the time. You can also put your home on the market, get an offer accepted with the idea that you're going to sell it, and then go out and try to find the right home for you so that, again, it's this concurrent close. I think that's realistic in most markets. And to be completely honest, that's probably what I would shoot for, unless, money's not really something you're worried about. So just my 2 cents.
I'm gonna go ask him for a loan if he's not worried about money, if he's got it like that.
Yeah, if you got it like that. Do we have additional questions? We got blessings coming from the villages. I think it's important to put those, any blessing we get, Josh, on the screen.
So Barb we got into her home a month ago. What I want to know is if she's got a golf cart yet. But she was renting in the villages prior to buying in the villages, so she may already have a sweet golf cart. But Barb, we need a picture of the golf cart, because I know you have to have one. You can't live in the villages and not have a golf cart. It's like a rule, right, Jeb?
I'm pretty sure, yeah, you can't move in there without a golf cart. In fact,
I want to see it. I want to see what kind of cart we have.
Yep. Send us a photo. We'll post it. Nia has a question. Loves the channel. So thank you, Nia. Strongly considering buying land versus a new construction home. Not only is the market volatile, but there's uncertainty here in Florida with insurance, property taxes. Your thoughts? So I'll tell you my thoughts, and Josh, you can give her your thoughts. I
will probably co-sign your thoughts.
There's a misconception on what buying land looks like. And then what happens once you buy the land versus buying a new construction home. Typically, most people think, hey, I'm going to go out and finance the land, and then I'm going to finance a house to be built on that land, or finance a trailer or a mobile home or manufacturer, whatever it is, to be put on the land at some point in the future. Understand that most banks, you can finance land, but it's not as easy as you think it is. Typically, you need a large down payment. Most people that buy land buy it in cash. So depending on your financial position, and what you're trying to accomplish, that might have to be done in cash. And then you go to building, again, construction loan, you need money. This isn't something that can typically just be financed 100% of the build. And I think that's the idea. People are like, well, I'm just, housing's too expensive. I'm just going to go buy a piece of land and build. It's going to be more expensive probably in most markets out there to do that combination of 2 things than it is just to buy an existing home or a new construction property. Plus, with new construction at the moment, there's a lot of incentives. Construction, builders are trying to do things to entice buyers out there. Now in Florida is one of the better times to probably be buying new construction, just because of some of the incentives. But again, you have to factor in the insurance and what you're comfortable
And she
with.
mentions the insurance, Jeb, but now everything being built in Florida, they have really restrictive hurricane guidelines of how they can build homes, and they have lower insurance rates than the older things that weren't built with those same guidelines. And I would say the same thing. Owning land is a liability. If you know, whether you can get it for putting 20% down, 30%, 50% down, if you finance any portion of it, you have a payment every month for something that isn't doing anything for you. I mean, yes, you own it. You're building equity in it, and you can put something on it in the future, but you still need somewhere to live. The thing that I would say for the folks where it can possibly make sense for a first-time buyer to consider this, you know, I've owned many properties. I've renovated and flipped many properties. I would be hesitant to go out and build a home just because I know it always takes longer and costs more. So that's a recipe for an experienced, financially savvy person, not for someone trying to get into their first home. If you were to try to do it for your first home, I would strongly consider a manufactured home where it can just be a short time frame with much more certainty on the costs. There's still going to be some wiggle room and some variation between what's bid and what is actually charged, but you would have a lot more certainty. And we're not talking about a single wide redneck trailer out in the woods. You know, the manufactured and some of the modular stuff that can be craned in are really, really nice properties.
Dude, I think you just maybe insulted some people there. You know, redneck, woods, like you basically talked about where I'm from.
Kinston?
Everything you said insulted me.
That's how Kinston rolls.
I mean, yes, you know, my dad lived in a trailer for a while in the woods. In fact, but yeah, you know, I'm insulted, Josh. That's what
Did he have electricity?
There were probably times he did not. But yes, I think for the most part he did. Yeah. So anyhow, let's see.
Jeb, I'm sad to find that Barb came back and says she has no golf cart. It is a rule.
Yet.
You are required. You're required. So yeah, hopefully that is the answer is yet. Barb, I'm going to get on Craigslist. I'm going to start looking. I'm going to find some nice used carts, and I'll make some suggestions, and then you can tell us when you get it.
We should raise money here to buy her a car.
Do a GoFundMe to get Barb a golf cart. I like it. I think it's a great idea.
Fantastic. Jamie says, are new builders usually interested in contingent buyers? Is that a common incentive or one that needs to be requested? I don't know that it's common. Typically what happens, here's the deal. Depends on the stage of the property that you're buying, right? I think builders try to shy away from contingent offers in the sense that you got something to sell. They don't want that because obviously if they tie up their property and somebody else were willing to come in and buy it, that's an issue. But at the same time, some of these builders have probably more inventory than they know what to do with. They would love a property to be tied up with the idea that somebody is willing to buy it. So I think you just got to check with the builder, the market that you're in, find out what they're willing to do. I think at the end of the day, for the most part, you're going to need at least the property in escrow in order to be considered. But again, I think it's going to be based on where you're located and what builder you're talking to. All right. Let's see. You see, dude, Dixie jumped right in there and helped me out, backed me up.
Listen, if you're off in Minnesota, you be careful what trailer you're in. You need nice insulation. You can freeze to death easy in Minnesota. It's not like Kinston where you don't have to worry about that stuff.
Bro, you just get high quality sleeping bags. It's perfect. You don't need a lot.
All right.
Don't need a lot, Josh. Just need love.
Speaking of not a lot, we don't have a lot of questions. So
we do not.
You guys
we've answered everything so this is where I'll talk about. There's over 100 people watching. I forgot to mention this at the top of the show, but we're doing another webinar for first-time home buyers. So anybody that's interested in becoming a homeowner this year, we've helped 3 people that had attended the last webinar that we did are actually all in a home right now and closed. Are they all closed or some in contract?
Well, no, the one you just got under contract last night.
Is that number 4?
They were at the first webinar.
Okay, so maybe that's number 4 then. But if you want to learn the process, want to go through the process, want to help guide you, there is a link scrolling at the bottom of the screen right now, jebsmith.net/webinar. We'll show you the link. It's going to happen on the 22nd, Josh. Is that right? The 22nd?
Yes, Tuesday the 22nd.
Tuesday the 22nd at 5 p.m. Pacific Standard Time. It'll be about 90 minutes. Last time we did about 60 to 75 minutes. This time we got your feedback. There's a couple things we want to add to it to make it a little bit more in depth. So we'll take it a little bit longer, but if you're interested, make sure you register. Again, it's free. Tell somebody you know that may be in the process. So hopefully that's helpful. All right. Anna Bear says, recently requested a tour for a property on Zillow a month ago. Ever since the tour, I've gotten a ton of calls from agents asking me about my home search. Zillow sold my info, question mark. If I'm being completely honest, I don't know how Zillow works these days. There's a couple of different ways that Zillow in the past has done business. And one of those is that as an agent, you can be part of their premier agent network, which means, when a listing comes in or somebody inquires on a property, you get a lead. And, in your case, that agent called you and showed you the property. Typically, it's only going to one person. I don't know if it ever gone to multiple people. But again, Zillow is a marketing platform, guys. They're not just a home site showing you values and properties. They're there to make money. So it could it's highly likely that your information could be sold multiple times to multiple agents in that situation. So I can't say for sure. Josh, Katie, advice to home buyer actively looking for homes when rates can drastically change between the time we submit an offer and actually hear back. $700,000 price range. So I think it's a good question.
It's a really good question. I will start with this advice. Be working with a mortgage professional that actually has a clue as to how the markets work. And let's rewind back to the beginning of the show. What did we say? Super volatile, and no one really knows what's coming next. But where I say that, we had a listener reach out this week, got a property under contract on Sunday, and on Monday set a time to call. Said, hey, I've already been pre-approved. They're pressuring me to sign their disclosures and get the appraisal order. So go through it. I said, okay. And all that volatility that we showed you, I looked at it. I go, when did they quote you? Well, they gave me the number on Friday. I said, okay, well, we're midday Tuesday. That number is going to be drastically different. So you got to look at that. I said, they didn't lock it yesterday, or did they lock it yesterday? No, he told me not to because he expected rates to get better. That is possibly the most insane thing I've ever heard, but I hear that all the time. So rather than helping you quantify the risk, they give you the hopeful thing like, just sign my disclosures. Let's order the appraisal. I think rates are going to go lower. Don't worry about the fact that the rate isn't where you want it to be. Versus the medicine that he needed to hear was, hey, rates have gone up. They could go up even more. If they go the other direction, we can probably renegotiate it back down. But where I was going with that, know someone that follows the markets that can explain to you what's going on, why the market is moving. No one can tell you what happens next, but they can tell you what information is coming and what it will mean if it comes in one way versus the other way, and help you quantify your risk tolerance. If you're shopping for homes, there are lock and shop programs. For the most part, I don't think they are beneficial or worthwhile. But those are the things that the lender that you're working with should be talking to you about. And, I'll close with my last little piece of this, Jeb. People all the time, yeah, I'm shopping around for a loan. And all anyone ever means by that is I want to see who's going to give me the lowest quote. Well, giving you the lowest quote and getting you the lowest locked interest rate when the time comes are two very, very different things. Getting you in the right program is a very, very different thing. Making sure you have a smooth and easy process, stress-free, very, very different thing. And those are the things you should be shopping for as much as, if not more than terms. So when you're selecting a lender, those are the things you should be interviewing for, and not someone who's pleasant and nice and seemed to answer my questions and told me yes every time I asked a question.
There you go. And if you want to get in touch with Josh and the team, jebsmith.net/start. It's on the bottom of the screen there, scrolling across. Again, get a quote. Never too early to have that conversation. And if you're already in the market, got a quote, it's a good place to check it and verify that you're getting good terms. So hopefully that's helpful. Josh, you just got another question here that I thought was good question. Steve follows up. Is it difficult to refi a home on leased land? Any difference than traditional refi? And the answer is yes. It's just as easy to refinance leased land as long as you have the term that Josh mentioned, right? It's 5 years plus the term of the loan that you're trying to get. So in the case of a 30-year fix, you want to do a 30-year fixed refinance, you need at least 35 years remaining on that lease. Say, for example, there's only 30 years remaining on that lease and you want to refinance back into a 30-year, you got a problem, right? You can only do a 25-year lease or 25-year loan on that unless the loan is the lease is extended on that property. So in most cases, it's not difficult and it's not any different than traditional outside of that additional time frame on the loan piece. So if you have questions, though, you can use that link at the bottom and get in touch with Josh. Jake locked in at 6.875 on a 30-year new build in California. Have the option of floating down just once. Closing is about 30 to 45 days. Think it'll go down some more, Josh. What do you think? What do you think happens over the next 30 days?
Literally, it could be either. If you told me rates are 0.5% higher, I could believe you. If you told me they were 0.5% lower, I could believe you. The tariff stuff is a true wild card, meaning there's anyone telling you they know what's going to happen is 100% full of shit. Like anyone who says they saw the last 5 days happening would just be lying to you. And if you look, there is a compelling narrative. Every time we've seen one of these whipsaws and move a different direction, you can see an explanation where, well, this is what the market's thinking right now. And you go, oh, I could see that. And then it whipsaws around the other way and you go, this is what the market's thinking right now. Oh, well, I could see that too. So there's plausible narratives all the way around, but no one even knows what is going to happen with these tariffs, much less how it impacts the U.S. and global economy going forward. So I hazard no guess.
No guess, he says. Okay. Easy enough. I think that's good. Josh, somebody wants us to pin the link into the comments here of the webinar. So can you do that? Do you have the ability to do that and pin that in there? I don't know if we can pin it from this side. I think we have to pin it from the main side, but from the actual YouTube side, which I was getting ready to do. But if you put it in there, I can go in there and do that here in just a moment. Let's see here. I absolutely hate the way that StreamYard shows me these comments, but you know, StreamYard is the only real platform out there that works. Josh, we got a comment from Ishmael. Considering getting a second property and renting out the current home, credit is not great. Do you recommend getting a HELOC to use as a down payment for potential second mortgage? So Josh, if I didn't have good credit, before you answer this, my focus would be on improving my credit. That's me. Credit impacts everything. Impacts obviously your interest rate, impacts how much you qualify for, impacts everything. And getting a higher score is not that difficult to do, guys. It's relatively easy to raise your credit score. So that would be my focus. But Josh, what are your thoughts on this?
Just before we move on from that, I'm writing a ebook on how to maximize your credit score in conjunction with buying a home. And that is one of the bonuses for anyone that registers and shows up and attends the webinar. That is going to be one of the giveaways that we have there. But that is my exact thought. It's like, if someone tells me they've got a 680, 660 credit score and they want to buy their first home, we can go through it and I can make sense of that. But if we're looking at investing and the cost of that, financing that investment is much more expensive, both in terms of the HELOC to access equity to make the purchase and then the end run financing that you're going to get. Step number one is getting your credit in order. If it's foundational. It's the bottom of the pyramid. You need to have some savings. You need to have income. You need to have savings. You have to have good credit. So the only reason to not have good credit is we have excessive debt or we have a bad payment history. So either of those tells me we're not quite ready to do this. So I know it wasn't the answer that you were hoping for, but like Jeb said, it's a fairly short timeline to be able to accomplish that. You know, we have people go from 580 credit scores to mid sixes in 3 to 6 months, and we have people go from mid sixes to mid sevens within 3 to 6 months. So if that's where you're at, that's what I would look at doing.
All right, good stuff. Again, I pinned jebsmith.net/webinar to the top there. That is the webinar that's going to happen on the 22nd of April. It's a free webinar. It's about 75 to 90 minutes. Completely walk you through the home buying process, everything you need to know to be like the other 4 people that we've helped from the first webinar in the first quarter get into a property. So it's where you want to be. It's easy, it's free, and it's a guide to help you become the educated home buyer. So Josh, we've got TMM saying loves the channel, been here. She's been here since the pandemic. So thank you. Pandemic. It seems like it was yesterday. But it wasn't
5 years.
Gosh.
5 years.
5 years. That is crazy. I've lost 5 years of my life since then. But I met a lot of wonderful people through here. We've helped a lot of people during that period of time. That's good. That's
Jeb,
good.
the right attitude is you've made 5 years of progress since that time. You're wiser. You're more accomplished. Everything's better. You have a new home.
There you go. All of the things you said are accurate, and I like that. I like looking back like that. Let's see, Josh. I saw some good one here. So we talked about that one. Brett says, what are some ways to make your offer stand out in a multiple offer situation? Outside of price, I think you can shorten the escrow term. Typical is 30 days. Find out from your lender how quickly they can do it. Doesn't necessarily mean the seller is going to agree to it, but you can get, stand a little bit more aggressive by offering a shorter time frame. The deposit, depending on the state you're located in, I wouldn't really go much over the 3% that, California, I think you're in California, if I remember correctly. 3% is where I would go on that. I wouldn't go above that, but that's pretty standard, what most agents are looking for and sellers are looking for. Down payments, obviously one of those things that, the more money you put down, in theory, the seller's probably going to look at your offer a little bit stronger. But when you got a good agent, that doesn't necessarily mean be the case. So I would say escrow term, deposit, if you're not already putting 3%, get close to 3% if possible. Contingency timeframes, waiving, if you're comfortable with the value, waiving appraisal. If you've been fully approved, maybe, talking to your lender, seeing if you can waive the loan contingency, and then shortening whatever contingencies you're okay with. Instead of 17 days in California, I like to come in and say 10 days, 10 days for everything. We'll get it done. But obviously everybody's got to be on the same page in order to make that happen. Do not waive the home inspection. Right. Get an inspection on the property. Don't be one of those crazy people that waives all contingencies. That's not the right approach, in my opinion. But those are really the simple things. Sometimes you can offer to pay your agent's compensation, right, in order to help your offer stand out, because now that's something that's negotiable. You can pay for your home warranty. There are different things you can do in that regard to help stand out.
Let's piggyback off what you said in terms of those timelines, Jeb. When you want to shorten the timelines, Jeb already said, make sure you check with your lender that it's doable. So both the loan approval and the appraisal, in general, we can get both those back within 7 days. And so remember, you're like, 7 days, can't we get it faster? Yeah, but there's 2 weekend days. So there's really only 5 business days. And what the most important part is when you do that, remember, there's some things that you have to do. You have to get the disclosures signed as soon as we send them out to you, because without the disclosures, we can't submit to underwriting, because we don't have your intent to proceed saying, I want this loan. So they're not going to underwrite it. Look at that damn light came on, Jeb. You
makes me so happy.
I was hidden.
I get a thrill out of it.
I'm hidden from my monitor. I moved like 2 inches. I don't even know what this. It's a little silly. But the other piece is that appraisal has to get ordered. You cannot be charged any fees until you have your disclosures and have them signed. So get those disclosures signed. And sometimes, many times, people are surprised to find that they're going to be asked to pay for the appraisal when the appraisal is ordered and not collect for it at closing. So remember, if your lender is doing, the loan officer is doing 7, 10, 15 loans that month, $700, $800, $600 a file adds up really quickly. If the mortgage company is doing 100, 200 loans, they can't float that out there. And the appraiser and your home inspector, they want to get paid at time of service. So they're not going to wait 30 days to get paid for something that they already did. It's really, from the loan side, the only thing you're going to pay up front. And generally from your side, Jeb, on the real estate side, the only thing they're going to pay up front is the inspection. But you need to be prepared for that. There is a flip side of it that many lenders are going to try and lock you in with that. There's really no 2 ways around it. So again, going back to that guy I talked to earlier this week, he said, I figured once I got my offer accepted, I got pre-approved by the realtor's preferred lender. And I just figured once we got an offer accepted, then I can shop and figure out who I wanted to use. That is not ever the way to do it, because these timelines that Jeb's talking about here, whether it's 7 days, 10 days, 14 days that we have for our contingencies, things have to happen quickly. So if you want to shop for a loan, do that ahead of time, and don't feel like you're just going to get pre-approved with whoever, because there will be plenty of time to do it later. We've had many people from the show that's like, we're just too far into it. We got to deal with this turd that we originally got pre-approved with and didn't have any intention to close with. And then furthermore, on top of that, Jeb, while you're out writing offers, if you write 5, 7, 10 offers, that person is doing work. They're giving you pre-approvals. They're updating you on numbers. Don't waste their time. Do your homework and due diligence ahead of time.
All right. Steve says, hit the like button, please, and thank you. So if you guys are enjoying or found any value, make sure you do that. It helps out, helps the algorithm there. Josh, we got a question here. That is not it. I clicked on that one a moment ago, but it was right around there. Steve again says, in your opinion, do you think the rapid changes in the market affect home supply? And I think the simple answer is yes. I think higher rates. This is the time of year when more homes are coming on the market. I've had 3 listing appointments this week. More people are considering selling their homes. And so higher rates means less demand, means more volatility, just in the market in general, and inventory is going to grow, which means more supply. So it doesn't mean a market crash. It just means inventory is going to continue growing. So I think yes, but on the flip side, if you see that reverse, it could have the opposite impact. But at the moment, it's looking like inventory is going to continue. And like I said at the beginning of the show, I think we'll probably surpass last year's numbers probably by mid-May. It would be my guess. Anna Bear, again, my agent told me today that one of the properties I wanted to tour, we could not because the listing agent knows my agent and won't let us see it. Literally said, F off to my agent in a suggest to prepare. And did you scroll down or what happened here? Okay, somebody, it said, F off to my agent in a text. Thoughts? First off, unethical. I think that's.
I don't think
obvious,
their sellers would be
obvious.
thrilled to know that they're
Sure.
letting personal agendas
But
with other agents.
It's more of an agent it's more of a broker to broker conversation. Your agent's broker should be contacting the broker on the other side, and figuring that part out, right? In no world should an agent be telling you that you can't see a property, or to another agent they can't be seeing a property unless the seller is saying that. And even then, you can't really do that. You gotta, if somebody wants to see the house, obviously you can make it tough for them to see it, but it's one of those things. So I would suggest having brokers communicate there to figure out a way to get in there, assuming you want to do that. Now, if it's coming from the seller, then that's probably not a house you want to see anyway, if that's the way they're approaching it. Ryan, I'm saving up a down payment, building credit, never had a credit card or debt before July. Probably 2 years from now is when I would start pushing to buy. What things would you suggest to prepare, Josh?
Get a couple pieces of credit. It's good, like in terms of maximizing your credit, having a couple lines of credit. So a couple of credit cards, even if they're secured cards, keep them under 10% of the limit, but use them. So don't keep them at 0, because then the credit scoring model can't see it. Under 10, definitely under 30%. 2 is better than 1. It's not going and charging a bunch up. It's not high utilization of those, but just showing and demonstrating that you're effectively using credit. Open up an installment debt. Go to Best Buy and buy a TV and make payments on it for 6 months, 10 months, whatever they'll give you. Find somewhere that will do 0% interest, and then open up a line of credit. It gives you low cost, but allows you to show different types of credit, and then just make the payments on time. Other than that, it's really all that you can do. Over time, as you have a greater depth of credit and more types of accounts, it will continue to improve, but definitely see people with limited credit within a year, well up into the 700s.
You can now get your rent reported on your credit report. So there are ways to do that out there. There are different sites that will report that directly to your credit report. That could like any sort of credit showing that you're making your payments on time is a positive thing. You can even have your cell phone bill and some of these things added to your credit report. Now, is that something you recommend, Josh, or no?
Well, you're talking about Experian Boost. Experian is the only one that makes it easy to do that. So for the mortgage, we need all 3 bureaus, and we're going to take the mid score. So for it to help you, it would need to be not your lowest score, and need to become that mid score. So it doesn't really make that much of a difference. If all 3 bureaus had something similar and you could get 15 or 20 points across the board, it would help. For the most part, it just makes your credit report look ugly because you have all this stuff that says self-reported telecom, self-reported whatever, and yeah.
All right, good stuff. Steve, it's the Steve Show, Josh. Does Huntington Beach have a strong demand rental market? Yes, the rental market here is strong. Housing affordability is low. Housing prices are high. A lot of people have to rent, therefore a lot of demand for rentals. Just all types of property. So yes, easy answer there. Josh, that is all of our questions at the moment.
That's it, and that's all.
That's it, and that's all. But we still have 4 minutes. So, is there anything you want to talk about?
Well, we'll address this really quickly. Manny said he's planning to lock in anytime this week. You think I should lock now or wait until Friday?
I think you should have locked Friday.
I think last Friday or Monday was a great time to have locked. So when we see questions like this, your loan officer should have given you some pretty solid advice by this point in time. So the fact that you're here and asking us tells us that you're not getting that advice there. So whenever we get these questions, I just ask, well, why aren't you working with someone who can guide you and walk you through this and help you make those decisions? Again, we have clients who decide not to lock. But we're going to have a conversation probably once a week about what that means and what's coming next. If you're not getting that level of advice, if the person that you're talking to doesn't know, and I get this, a lot of times you guys don't know. So what we hear is just crazy, crazy shit that dumb loan officers will make up to make someone believe that they know what's going on. And it can be hard for you to see through salesman stuff, but I can't stress how important it is to talk to someone that knows what in the hell they're talking about and can walk you through this.
Well, here's the deal. Tomorrow morning, CPI gets reported. So you're not locking your loan tonight. So between now and when the next time to lock your loan, there's going to be a CPI report. If the CPI number is strong, in favor of inflation going down, then tomorrow could be a good day to lock your rate. If it goes up, tomorrow could be a good day to lock your rate. I think either way, the rest of the week, there's not really a lot of information out there. So by the time you decide to lock, the information is going to be in the market for the most part. So I think, no sense in pushing it off either way, but I think, you'll know tomorrow one way or the other. Josh, let's see.
You like answering Steve's questions. He asked us the Experian
I have no
boost.
idea.
Experian boost, does it affect DTI? It does not. Any of the self-reported stuff can be ignored for those purposes.
Well, there you go. I actually didn't know the answer to that. Okay, Josh, that's where we're at. So if you're still watching right now and you haven't heard us say this already, there is a live webinar on April 22nd at 5 p.m. Pacific Standard Time, where Josh and I are going to walk you through the home buying process from A to Z, help you become educated home buyers, know how to submit offers, know how to make offers, know how the process works, all of that good stuff that we're going to talk about in that episode. There's going to be some bonus material as well, helping you with the credit. What's the other one, Josh, that we're doing?
The bonuses?
Yeah.
A guide to selecting a realtor, including the referral link with a potential credit to the buyer, and then also a complete and comprehensive checklist for every step of the process. You know what you should be doing and when.
There you go. So if you're interested in joining us for that webinar, jebsmith.net/webinar, at the bottom of the screen, we'll get you in touch with that. If you'd like to speak with Josh, you can do that using jebsmith.net/start. But anything else, Josh? Anything you want to add this evening before we exit?
I will go back and before we close, just reiterate, you shouldn't be having to go online and get your questions answered. If you're in process, you should have open lines of communication with your loan officer. You should have confidence in them and know that they're going to get you the right and honest answers. And if not, work with someone who is. Again, that link of Jeb's, it's almost 30 states now, closing in on 30 states. And I would say within the next 18 months, we'll have about 90% of the states where we can help you. And again, by no stretch of the imagination, what are you doing over there?
Josh, I pulled the microphone completely out of the thing here. I mean, this is what we're doing now. I'm just going to hold my mic like this.
You need to.
Dude, I'm just so strong.
I see that. But you need to be working with someone. Again, I will just reiterate, the thing we always get is, how do I get the world's rock bottom lowest interest rate? You see here, people rarely lock at the optimal time. The quote that you get is great for that day, but you end up not locking at the right time. It's off. You end up closing late. You end up stressed. You end up not qualifying. Make sure that you're working with someone that you have a high degree of confidence in. And if you haven't found that person yet, use the link, get connected. We would love to help you.
All right. Until next time, guys. Adios.
Amigos.